You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Our share value right now is at 24 cents. A medium value gets it up to $2.40. And if you just go after the similar exploration and prospect types that we've been making our money at on the block, we're between $3 to $5.50 a share.
I'm Bill Powers. Thank you for tuning in. Joining me today is Arthur Halleran. He is the CEO of Trillion Energy, one of our sponsors, and a company in which I am heavily invested in. Many of you have continued to reach out to me. Bill, are you still invested in Trillion? And I can say I bought not a small amount of shares in January and February of this year after speaking to Art for the first time. And I still own all those shares. A 10 bagger at one point for me this year wasn't enough because I see the stock having 20 to 50 plus potential. So I still own all my shares for the reasons we're going to talk about today. Art's been doing the webinar circuit. So I asked Art to come on this channel, Mining Stock Education, to provide you with an update. And this presentation will be a little more technical. He's going to talk about what they're doing developmental wise, going through the slides of their presentation. So hopefully you get a deeper dive into the company and specifically into the geological potential. Art's going to break that down. Remember, he's got 40 years experience doing this. He's built $500 million natural gas and oil companies. So he knows what to look for. He knows what he has here. He's been the CEO for 4 years. Not working for a salary, just $8,000 a month, which he's taken in stock compensation because of the potential of the SASB gas field, which we're going to talk about today. So Art, with that introduction, please take it away.
Okay, Bill, thanks a lot for the opportunity again to show a more technical aspect of the project so that people will see that there is no risk for the first couple of phases. So on this slide here, you can actually see one of our platforms. We have 4 of them, and this is, of course, in the Black Sea. And we trade on the CSC, the Frankfurt, and the OTC. So just to refresh, people have seen this talk before, the other ones, Trillion is an oil and gas producer in Turkey, and we have a very experienced management. And we're going to be doing the major development of our Black Sea gas asset, which, if you remember, we own 49% of about $608 million already in place asset with pipelines, offshore platforms, onshore facilities, and TPAO is our 51% partner. And we produce $355 million worth of gas from the 4 pools we've been producing from. We have large gas adds, which I'll show you, 4 discovered unproduced gas pools, 6 low-risk development pools, and there's additional exploration on the block. I'll also show you some of the exploration that is off the block, which is not really included in my money evaluation here. We do have an LOI financing for $17.5 million to start this development, and we're in the process of just getting all the government paper in place. We're at the $6 to $7 gas range. The big game changer is that TPAO has now discovered, they've drilled 4 wells, every one hit, and they now have 19 TCF of gas in the north, the Black Sea north of us. Why this is a game changer is that we had a lot of other larger structures mapped, and the risk was there was not enough gas to charge the structures, but now we know that this is not true. It just gives you some idea of the value. Here is our field. This is the large government 19 TCF. And we had 2 third-party engineering reports on the developed unproduced gas pools and the low risk. And so this is the low case, 100% case, and it gives us a value of $144 million US NPV10. But we have 14 additional other prospects. This just shows, this is the Black Sea, this is Turkey, our 4 platforms, our gas lines coming from our platforms into our facility. This is what makes this such a great asset, is all the infrastructure is already in and paid for. This is a bit of more detail about our gas, SAS, the gas field. These are all the pools that are the low risk and the discovered but not produced. The red stars are the 4 fields that we have produced $355 million of gas from. With the financing, our first project will be 5 new gas wells drilled, and there's also will be 2 recompletions. The 5 yellow stars are the pools that we're going to be drilling. And I have this thing circled as an example. I just want to illustrate the technical data we have, why we are so sure what is there. This is the kind of structure we're looking for. It's about 1 kilometer wide. This is a seismic line, a vertical section, very good quality. In this example, it's a gas valve, and you can actually see an anomaly that represents actual gas field sands. The example I'm using is Bay Hanley 1. This is the old well that was drilled in the early 2000s. So it is tested, logged, and mapped, and this one tested 7.5 million cubic feet per day from 3 zones. This is the logging of the formation. So they sent an instrument down the borehole, and what this shows is the actual zones that were tested for gas. You can see they're quite thick. So these 3 zones tested 7.5 million cubic feet per day. These are the only zones that a third-party engineering firm can use to give reserves. So it's the low case scenario, because in this well, we have 1, 2, 3, 4 other zones that are gas, but have not been tested and therefore cannot be included in the reserve calculations. Again, this is the mapping by the third party. The reason why I use a third party is because that way I can say that there is no management bias. I will put in our learnings in a minute. So here's the mapping by the engineering firm that gave us the reserve. This is the 1C. So the low case, the most likely, the high case. So this is what we call 2P, and this is 3P. And so all it really is taking the existing net pay that they have and then mapping based on what they see in the seismic and the logs. And they always got to have a high, medium, and low case. So when we're going to drill that location, here is the platform. And we bring up a jackup rig. We bring it up and we snug it. And this actually does go right over the platform, and we drill out from under the platform. And the reason why we can drill these pools is because it is much cheaper to bring a jackup rig and attach it to our production platform than bring in a standalone or a jackup rig that's not attached. And it saves us about $3 million a well at this time. And we are the experts in this because we always operate the other wells, which we have done the same thing, directionally drill off of our platform. This is the actual trajectory of our borehole. This is done by Schlumberger, and because they are the leading in directional drilling and calculating the trajectory of the borehole, we engaged them, and they will be doing the work, the actual drilling, and the directional drilling, and so on, the testing. So an example, some of the learnings that we have, we'll be logging the hole at the same time we drill, whereas before we drilled the hole, conditioned it, set in some logging tools, and that caused 2 or 3 extra days of time, plus you worry about the hole stability. So instead, we're just going to drill and log at the same time. So here's the platform. We drill from the platform. This is now all the sediments. We drill through the sediments. From our previous drilled old discovery well, we have very good control. And this is a long strike, so the structure is in front of it. So we know exactly what pay we have here, so there's no risk. We want to encounter the lower pay at the best angle. What makes this so cheap is that once we drill it, we put the surface casing and the regular casing in. Our drill hole now is our pipe, and it goes into the facility. We complete this, and we have instant production right away. And within 45 days, basically, of releasing the rig and production, we get our first check. Whereas before, you'd have to do a subsea completion and then a subsea tie-in, whereas we're going to be producing right up the borehole as a pipeline. This is the program for the $17.5 million. It's going to cost us $22 million, but you'll see that we will be generating income, like I said, predominantly right away. And this, I have an A here, which I'll show you later on why it's important. So this is our program A. Instead of waiting for the larger leg jackup rig, which is not available until March, this one is for the farthest out platform. We have another rig called Saturn. Its legs are a bit shorter, but it can do the first couple of drilling. We'll spud October 21st. We'll do a recompletion. We'll do a mold. The first well will spud, and then mold, and then drill our second well. So we'll do 2 wells and 1 recompletion. Then there's a little bit of a hiatus. The other rig comes in, and we do 3 more wells and another recompletion. So for this program, we have 5 wells, and we'll drill 5 new pools, those yellow stars, and recomplete 2 new wells. So we'll continue. This is the drilling that we'll do in 2022, 2023 from our revenue that we will be generating. And also what happens is that some of the pools that we will be drilling previously, during our production, we will record the pressure, and it will indicate whether we need to put 2 more wells or 1 more well in the pool to drain it. And so it's basically a follow-up. The other ones are our low-risk development locations. So the yellow stars here is our next program. And that will be 8 wells and 1 re-entry. And we will spud that October 2022, and carry right on until 2023. Our capex for that is about $44 million. This is the production profile. If we stack both A and B, this is net to us, and it's yearly production. This just puts it into actual net cash flow after cost. Because if you remember, I mentioned $1.4, $1.8 million per month net cash flow. And that will be occurring for the A drilling program, which is the first $21 million. Then there's a bit of a hiatus. And then we're going to be doing the 2022-2023 drilling program. And we'll be stacking those wells and putting them on. And so this is the monthly net after cost cash flows, $2 trillion for our program. Then you'll start having a large tail as it declines. But we have many stratigraphic exploration drilling prospects that will flatten this curve. This is an example of exploration stratigraphic targets. These are our existing pools that we produce, and we have these other sands, which are not the structural ones that we have for our development locations. And what we want to do for this one, the old seismic, we can see gas saturation, but there's some gray areas, and so we want to de-risk it. So to redo the seismic costs us about $500,000, and then we'll do some modern technical work on the seismic, which will allow us to see the gas-saturated sands versus the water-saturated sands. And that just de-risks it, because if 1 well costs $8 million, to spend $500,000 to get the seismic redone is a no-brainer. This just now relates to the share value. We were quite low, below 10 cents, 6, 7 cents. And then we had our first interview with Phil, which was quite good. We kind of skyrocketed up, and then it's kind of leveled off because we haven't had news. We're working on the financing, but we stayed fairly high. But I want to illustrate that today we are still severely undervalued share-wise. So our market cap now is about 38 million US from 10 million before. This one is a comparison that was just done by Fundamental. So if we're at about 25 cents US, they right now give 50 cents US, which I say is low, but it's their opinion. Here's the company that I founded in Colombia. It's worth $800 million. The reason why I bring it up is that, to me, it is like Trillion is like another Canacol. Trillion has got an asset that is just fantastic. Low risk. We have a paid for infrastructure. All we have to do is the actions to capture that value. And at 25 cents US, there is a big upside for the investors, but also for me. Like I said in the past interviews, I spent 4 years working on this, rolling all my potential into paper, reinvested back into Trillion Energy. Over those 4 years, I could have done many other projects, but I stuck to this project because there's a potential to make a really nice return. So here is a very important slide. It just shows you the potential share value based on what we have defined. So on the far column here, we have the third-party engineering report, which I showed you, the low risk. So I told you before, it's $145 million NPV10 for the discovered non-produced pools and a low risk development. We have a 94-cent US value. You've seen this. I've shown you how there's basically no risk. We have so much control. If you upsize it to a 3P, you're up to 269 million NPV10 and $1.74 US. The middle two columns are our estimates of it, and we just put in our own learnings, which are, we know the recovery factor is 80%, whereas the third-party engineering for the 2P used a 60% recovery. So we put in the 80%. We also were penalized by the third-party 10% risk factor. If we could not get the money, well, we're going to get the money, we have the money. And so you remove that. So using exactly the same data, geological data, just putting proper recovery in, we're now at 214 million NPV10. Our shares are $1.40. And like I say, you upsize it to 3P, you're $2.40 US and an NPV of $368 million. Again, I can't stress, I've shown you the data we have. There is basically no risk or very low risk for this. The next one brings in the exploration plays that I showed you on the bot, the stratigraphic. And that could give us a value of slightly under $500 million, a share value of $2.90 up to $800 million, a share value of $5.40. And that is a Canacol analog, something I've done before. The important thing also to stress is this value is only that occurs on the block with similar prospect types. Okay, that's an important concept. This is the exploration for gas pools. Excuse me. Here's our SASB gas block. So you can see the size of it. That is the large 19 TCF discovery. Here again is our SASB. We've been in this area for 20 years. We have 20 years of data. We at one time had an exploration block in this red area. And this is some of the area I'm going to re-grab. And so we have all the seismic, all the mapping, all the geological data. We have a whole selection of prospects, which we did not pursue because at that time it was thought there wasn't enough gas generated, whereas now we know that that is not a true statement. So just to give you some of the size of these structures that we know exist and that we have mapped, I removed where the locations are, but you can see right here is one of the pools that we produce from, and you can see that tiny little thing there. That is the pool that we are going to be making. The size of the pools we're going to be making up to $800 million NPV10, right? We're getting BCF of gas from those pools. Same sediment package you come across, you have the structure that's 9 kilometers in size now. This is just a simple structural concept that we will be attempting to pursue. Again, in another direction, we have 4 kilometer size prospects. This again comes off our field in a direction, and you can see you have this large structure, 35 kilometers in size. So you're going to have structural and stratigraphic troughs here, very large stratigraphic. And what will happen is the sands will be deposited as a wedge, and they will go up dip, and they will be charged with gas. And so you're not talking BCF here, you're talking TCF. So these are very large impact. So if we can have $5 a share just from what we have on our block, I can't even give an estimate what this value will give to the shares. So for a quick conclusion, and then I'll show you one more slide after this. Infrastructure is paid for. We have 100 BCF of low-risk gas that can be developed on our block. We have an LOI for $17.5 million financing to start the development. Our share value right now is at 24 cents. A medium value gives it up to $2.40. And if you just go after the similar exploration and prospect types that we've been making our money at on the block, we're between $3 to $5.50 a share. Okay, the proposed locations are very well defined. Production starts almost immediately with the wells getting. Once they start producing, we get our check in 45 days. And the projected net after cost cash flow will be 1.8 million March 2022. That's based on the programs, and 2.7 by June 2022, and it'll peak at November 2023. And that's without any exploration. And then we have the larger, very larger exploration targets that I haven't included on this. And I always forget because I get so excited about the gas. We're actually going to be making $3 million a year on our oil field. And many companies, that's all they have. They have an oil field like this that produces 150 barrels of oil per day. With the price of oil going up, we've doubled our revenue from the same time from January to May this year compared to last year. And I suspect we'll be making over $3 million a year from this oil field. And that's pretty well my my conversation, my presentation.